Today we are here to look at another aspect of analytics in BFSI, and this is related to the late payments or the people who do not pay back the loans in time. In a retail banking, the profit and loss account, especially in a credit card or a loan scenario, looks like this. We have new accounts which are acquired, and then there is interest that we earn on those accounts. So we lend them some money, say 1 lakh rupees, and then we expect an interest of say 10%. So we assume that 10,000 rupees we will get at the end of a certain period, say 1 year. So a receivable from that customer is 1,10,000 rupees. This is generally broken down into EMIs. So in this case, we need to pay back 1,10,000 rupees, which will work out to be an EMI or equated monthly installment of 9,167 rupees per month. What really happens is that in case the customer does not pay back this money in time, the bank will have to resort to certain methodologies to get back its money. So in the initial part, when we take a credit card or a loan from a bank, we sign documents saying that whatever money as customers we shall take from the bank, we shall repay on the terms and conditions mentioned in that sheet of paper. This process of taking back money from customers who have taken the money and are unable to pay back the bank is called collections or recoveries. We can understand, I'm sure, that if we don't get money back on that account, our effective profitability of the portfolio will reduce. So if suppose we have lent out money at 10%, and if 10 people do not pay back in a portfolio of 100, we will our effective rate of interest on that entire portfolio will reduce to say 9% or 8%, depending on what type of customer, what volume of credit that customer has taken. So this process of loss is a risk that the bank undertakes, and therefore collections is very closely associated with risk management and risk. So when we look at marketing analytics versus risk analytics in BFSI, we see that in general there are two distinct teams which will handle both these types of analytics. The marketing analytics team will mainly do work which will be related to profit-based customer acquisition strategy, a lot of segmentation, which will help understand your defend, grow segments of customers, revenue scorecards, example total 180 days revenue, 360 days revenue, lifetime value, campaign management, cross-sell scorecards, retention and activation exercises, loyalty and win back exercises, and pricing analytics. Most of these types of analytics would be done under marketing, and this would involve cluster analysis, shade analysis, decision trees, and then of course your regression models, etc. So under marketing analytics, what becomes really important is segmentation, shade analysis, decision trees, and logistic regression, etc. to a lesser extent. Risk analytics is mostly geared towards credit delinquency scorecards, where you want to predict the probability of default, customer approval and conversion scorecards, optimal amount pricing, portfolio loss forecasting, collection analytics, fraud analytics, and Basel II analytics. Now Basel III analytics also. Now, so you can see that a lot of the risk-based analytics is geared towards predicting delinquency or loss in your portfolio, the type of customers who are most likely to inflict loss on you, inflict fraud on you. And then of course there is a lot of mandatory reporting which has to happen under Basel II, and your central bank has certain mandatory reports that every bank or portfolio will have to make. So let's take a look at collections. What is delinquency? An account on which the customer has not given the money, that is an account past due, is called a delinquent account. So how do we decide delinquency in a credit card industry, which is basically a revolving debt? In credit cards, an account is reported as delinquent if for more than 30 days after the bill date, the customer or card holder has not made at least a minimum payment. So most of our credit card bills will have a minimum payment due and then the total outstanding. So if you keep making your minimum payment, you are non-delinquent. Accounts that are outstanding after 180 days is the point where the companies realize that they may not be able to collect on that set of customers. So a customer who hasn't paid up for 180 days, that is 6 months, is most likely not to pay you up ever. So this is after you've made all the efforts to contact the customer and make him pay you the money. Then we'll come to a very important concept called the FPD and EPD. EPD is early payment default, which occurs when a borrower fails to make the loan's first, second or third payment by the due date. So here we've written, as you see on the slide, it's called mortgage payment, but this applies to all loan products. Loans with a delinquent first month is called FPD, first payment due, with the second month is called second payment due, and with 3 consecutive months is called third payment due customer. So it's called FPD, SPD and TPD customer. If there is a high number of EPD loans, investors become apprehensive about the credit and underwriting quality of the loan and the ability of the collection agencies to overcome the obstacles and get the money from such customers. So you are booking such bad quality customers that they don't even pay up the first installment of the loan, or they consecutively don't pay up 2 installments of the loan, and these are the first 2 installments of the loan. In risk, there are some other metrics of collections which are also seen, like 1 check bounce in first 6 months, 2 check bounces in first 6 months. Such metrics are also tracked because these are all indicators of people who have poor credit quality, because they have not even in the first 6 months. Suppose a personal loan is of 3 years, 36 months. Even in the initial part, in the first 6 months itself, the customer is unable to pay up a couple of EMIs, or he has had to have collections contact him to ensure payments. Now these are all indicators of bad credit quality or probable fraud in our system. So why analytics? It is extremely challenging to get customers who default to pay up. You have a very short window. So 30 days, 60 days, 90 days window, you have to ensure that the customer pays up. These are tracked not only within the bank but by external agencies as well as by the central bank to understand the quality of your portfolio. Some customers may never pay, and these could be your fraud customers or very bad credit quality customers, while others may pay without a reminder. So these are your really good customers. So the people who pay without a reminder are your best customers. Some may need to be pursued. Some people you have to send an SMS. Some people you have to call up and then they pay. So what does analytics help you do? Analytics helps the organization to contact the right accounts quickly and frequently. So the ones who need to be pursued are pursued quickly and frequently. Improve productivity because you end up not calling the ones who don't need to be pursued, who do not need a reminder. Use workflows that suit the company's need. Have the right strategy, that is, should you call by phone, send an email or a voicemail for each account. You segment your collectible pool into different segments which need different types of calling or contact strategy. And then you close loop with the risk teams. As your collection pool is a very distinct pool of bad credit in your portfolio, you have to close loop with risk teams to ensure that such bad credit does not get booked on a repeated manner. So when we take a look at collections decisions, we can say that the collections life cycle includes 3 stages depending on the delinquency associated with the accounts and the objective of the collections team in each stage. So the lowest risk accounts are the ones with self-cure. These are the ones who miss a payment and then realize that they've missed a payment and come and pay up to you. Then you have the need and respond to contact. So the people who need you to call them up or touch base with them, but they respond to the contact. So these guys, you have to call them on a regular basis, but you can be very polite with them. You can send an SMS. A lot of them may revert on or take a cue from the SMS and pay up. And then you have the third category. This is the difficult to cure ones, where despite repeated calling or repeated visits to their residence, etc., we do not find them paying up. You must know that in the papers there was a lot of articles some time back saying how collection agents had roughed up people, and RBI has come up with some very distinct and stringent quality norms for the type of process you need to follow for collections. You cannot go and contact people at unearthly hours or misbehave with people, irrespective of the fact that they may not have been returning the loan. So what is the process that comes for collections analytics? You have the data. You can use scorecards and modeling to figure out what is the probability of default for each type of customers. You can then segment your customers into different types of customers who need different types of treatment. The ones who self cure, the ones who respond to contract, and the ones who are difficult to cure. Then you divide them for treatment optimization. Should you send an email, and when should you send it? Should you send an SMS? Should you telecall? Then you put this set of customers for implementing and queuing into a calling queue or mass SMS. So those types of strategies you do. So you do forecasts, performance reports, and strategy dashboards to see that how effective is the strategy that you are using to get the money back from this set of defaulting customers. So you may say, why analytics? A collectible pool would not be more than say 10 to 20% of my total pool. So why should I use analytics? The reason is that the desired objective of each segment is different, and therefore there should be a strategy deployment. So the collection goal for a high risk delinquent customer is to recover as much of the money owed as possible within an acceptable time frame. You might actually have to restructure the loan. You might have to give him payment options which you don't generally give your customers. In the late stages of delinquency, the goal is to maximize the collections by making the customers pay as much as he can. Sometimes at 180 DPD, you have written off the debt. Now, if it's a 1 lakh debt and the customer cannot pay it up, you would try to get as much as possible from him. Generally, what is seen is that in the early stages of delinquency, the percentage of self-cures or self-pays will be higher due to specific behavior patterns. So, if you look at the pool which has not paid you for 30 to 45 days, you will find that 80% of them could fall into the self-cures pattern. So these guys, if given would cure by themselves, and maybe 10% would need reminder calling and 10% would flow forward. However, if you look at the pool of people who have not paid you for 60 to 90 days, you will find that people who will self-cure in this segment will be very low. Why? Because the ones who had to self-cure would do it earlier. None of us would want to accumulate 3 months of EMI and then pay up. In that segment, you might find that 80% of the accounts need to be contacted physically. You might have to arrange for some pressure tactics, like actually sending your collector home and asking that person to give a check in the name of the company, etc. So analytics helps us to identify the characteristics of self-cures. It does not make sense for us as a company to use our monetary resources to pay collectors to go and touch this segment, because they would anyway pay up. Then segmenting the remaining delinquent accounts into high, medium and low risk segments. The one which are high risk segments, you might wish to give to a skip tracing agency. Why are they high risk? Because even at 30 days past due, you might find that their house is locked, their telephone number is not traceable. the chance that such a customer will come back and pay you is very minimal. So he might be a high risk account. You should have to give it to a different type of agency which handles such customers. Collection Analytics presents a credit card portfolio management solution by providing the right treatment to the right customer so that we can reduce receivable balances, increase operational profitability, and maintain client satisfaction. One of the things which comes out of segmentation or studying the collectible pool is the line enhancement strategy. You might not wish to enhance the line of a person who has shown himself to be not worthy of being given the current line itself. So he seems to not be able to pay up with the less limit that he has. So the chance he will pay up if you increase the limit, spend limit on his card is very minuscule. Now, business friendly reporting highlights trends in account receivable balance and recovery performance over time, allowing the validation of the results of the strategies. Always remember, analytics does not end with just performing the analysis and suggesting the strategy. You have to track the strategy outcome over a period of time to be able to say with confidence if you are using the right strategy for the right set of customers.